So this next panel is about something near and dear to my heart. I mentioned earlier that I started out as an insurance lawyer suing insurance companies. Sorry, Jared. There's a reason why I shifted from insurance to crypto, and it actually has something to do with blockchain and crypto, but I'm told I have to get back on track, so I'm not going to tell you about that. But this panel is about managing, what do we call it? Solutions for controlling blockchain and crypto liabilities. Really pleased to have with us my law partner, Dan Healy. Dan, like me, is an insurance coverage lawyer, in addition to being a lot of other things, but we were at a firm that focused on suing insurance companies together for several years before we came to Brown Rudnick. Jared Gdanski, my friend and client, who is the CEO and founder of Evertas, which is a Lloyd's cover holder, which insures crypto risk. I believe that they are the only such.
We're the only Lloyd's cover holder.
The only Lloyd's cover holder. And it's very, very cool because you've got this 17th century company wrapped around this thing that insures smart contract risk. And then also really pleased to have with us Mark, can I pronounce your name correctly? Last name is
DiMichael.
DiMichael, forensic accountant with Citrin, Cooperman, and Sandra Rowe, one of with GBBC, CEO of it, and one of the sponsors of today's presentation. Can you move that clock back to 40 minutes so they're not dinged for me being long-winded, please? There we go. All right. The floor is yours. Thank you.
Great. Well, first of all, welcome everyone. I am delighted and grateful to Stephen and Dan and all the other partners who are here from the Brown Rudnick team. We're going to talk about the most important topic today, which is the risks, and then managing risks and solutions around digital assets and blockchain. I want to make a full disclosure because I know I am surrounded by a room full of lawyers. I am an early advisor and investor and had a number of different roles with Evertas in its early history. And I've seen the journey of literally zero insurance for crypto assets when I was at CME Group, looking for insurance, by the way, back in 2015-16 era, to now today where there are some solutions and work being done. But I'm going to start with Dan, who's going to do a quick intro just on what are the areas that you're focusing on right now related to risks, and then we'll go down the line.
Sure, absolutely. Thank you very much. And as you heard, I focus a lot of my practice on insurance coverage. I also have a history of working for the DOJ at the tax division, and so that comes into play in this particular area as well. If you look up the various risks, and when you come at how we're looking at this, you sort of identify what risks are out there, and we're trying to find some solutions, and particularly looking at the insurance aspect of it. So everything out there you'll see is tax and compliance and regulatory. But digging down a little deeper and looking at what those risks might be, you can't necessarily buy an insurance policy to help you stay in compliance. But looking at what does it mean when you're trying to deal with regulatory risk, and does it take the form of fines and penalties? Does it take the form of ending up having your business being subject to investigations and potentially lawsuits? Our first panel today was talking about bankruptcy. And a lot of things came out there in terms of what layers of risks there are. Another whole set of risks are, how are you operating your company? And do you have a lot of controls in place in order to keep things working the way that they're at least supposed to work? And are you, being out front and trying to avoid those risks? But then on the flip side, because as we've seen, sometimes you can't avoid all of those risks. Do you have something in place that can help you? And, in those bankruptcies, the E&O policies, the D&O policies, and a lot of other things come into play. So identifying, well, what does it look like when I don't have my operational risk exactly the way I wanted to have it? Am I going to get sued by somebody? Is it going to turn out that, when I have a valuation problem, it's not just the value of the crypto or the digital asset that I'm holding, but it's actually a management liability issue that I need to think about, and how do I avoid that?
Great. And we are very fortunate to have an accountant in the room. Mark?
Yes.
Over to you. What are the risks that you think about?
Thank you. Yeah, unfortunately, accounting and tax should not be a risk that we have to think about. But the way the laws are laid out, and digital assets are so new, they don't necessarily fit into the right or understandable buckets for accounting and tax, and all these regulations. There's a number of filings that are. I'll go into more detail on these later. But accounting and tax shouldn't really be a risk that people are concerned about, but unfortunately in this industry it is. And that's a decision we've all kind of made together. We're all in this industry, so we have to accept the fact that there's regulatory risk and price fluctuation. Like all of our fortunes and futures will rise and fall to some extent with the price of Bitcoin. That's a risk in and of itself as well. So we advise on that from the accounting and tax side. My firm is Citrin Cooperman. We're a full-service accounting firm, and I'm also a forensic accountant and a valuation expert. So we value assets for a number of different purposes, and we also do forensic accounting investigations for a number of different purposes as well. Fraud is a major risk in this area as well, so hopefully I'll be able to touch on some of those issues as we go on today.
Great, and we're going to deep dive into a couple more mundane examples, but also some very serious examples of issues on the tax side. But before we do that, Jared?
All right. So a tax lawyer, an accountant, and an insurance salesman walk into a panel. The punchline is you're watching it. There's a reason they stopped to give you extra time to get coffee for this panel, although actually it is quite exciting. Evertas has been around for 7 years. We're the first crypto insurance company. Sandra and I met starting the EA, I don't know, back right after, I guess, Ethereum launched.
It's okay, you're a crypto boomer, yes.
A retiree, they cart me out here, my oxygen tubing and everything. Sort of all this was really a need for insurance as part of institutional custody. All right, if you looked at the three prongs of institutional custody, you had kind of an ability to custody the asset, you had to have legal and regulatory kind of clarity, and you need to have insurance. 2016, 2017, there were institutional custody solutions. There are more now, obviously. Legal and regulatory issues were still kind of up in flight, but lawyers, we were told, I was working at a very large custodian bank, we were told for about $2 million of billings, we'd have all this legal certainty we needed. And then finally, you needed insurance, which, as I always say, was kind of like crickets followed by tumbleweeds. And so we went out to solve this problem, and it's a pretty substantial one. Insurance really is a tool to kind of unlock industries, and it's a sign of a more mature and professional and growing industry. And so we service all the insurance needs for the crypto industry. We do insurance for miners. We insure over 30% of all Bitcoin halving power. We have the largest line for mining insurance. We actually have we have some new things coming out too, D&O, cyber, general liability, custody insurance, smart contract insurance. So what we did was we took a bunch of crypto experts, crypto natives. So we had to kind of solve how do you assess risk in this space, right? And risk is really complicated, but insurance is interesting in that you take very complicated risks. You confine it and constrain it in something called an insurance policy or an insurance contract. Policies are just contracts. And then you put a number on it in the form of your premium. To support this, we have the only claims group in the world, which also is part of our professional services team. And so we help with incident response and coordinating problems. And we'd like to be kind of more left of boom and help with kind of preemptive and proactive management of security issues for Web 2 and Web 3 issues.
Great. Well, I wanted to actually ask, I think we may have had a couple slides. Are they actually available to show? If not, we can always distribute them later. We bucketed the risks into 3 different major buckets. One was around business and operational risks, which, by the way, is pretty much for any business, right? And then another bucket we had was actually technological, cybersecurity risks, some of which are very common to other businesses, but then also there's very specific things related to cryptocurrency. And then the third bucket, which I think Mark alluded to, which were a lot more about price fluctuation valuation, which is for cryptocurrencies in particular, quite a difficult topic. It shouldn't be, but it is actually quite a difficult topic. So let's talk about those 3 buckets, if we may, about the risks themselves. And let's just talk about some very specific examples. So from a legal perspective, Dan, if you think about which risks you find to be the most problematic at the moment in terms of gaps or where we need to work on. Can you name a few and just let us know what you think?
Sure. I think, when we start with the first topic with operational, and I mentioned this before, you have sort of obvious regulatory issues. A lot of it is talked about in terms of compliance, and obviously that's very important. But another issue is, okay, if your business were to be subject to an investigation by, I'm from down in DC, and so is Sandra, one of these major regulatory agencies, it's quite expensive. Just responding is quite expensive. I have a client who's, they're involved in some crypto, but they just recently got a subpoena from the SEC, and it's going to cost them hundreds of thousands of dollars to respond to it. That's just how, it's a necessity of doing business these days. And do you have a way of dealing with that? Do you have the ability to pay for it? And do you have the ability to have people internally or hire an outside law firm to work through that? And at the end of it, there could be fines and penalties that can be quite expensive. Hopefully you're able to avoid most of those, but in the regulatory environment we're in right now, there's a lot of fines and penalties. That's just how things are going. And when you start entering technology into it, you also have to think about, okay, do you have data that's involved beyond cryptocurrency, and where is that being stored and housed? And that's not absolutely narrow to blockchain or crypto or digital assets, but in reality, there's something that your business is likely doing that involves the digital assets, which is why you have an operation, and you're not just sitting there holding a digital asset. And what are you using it for? And for example, I can anonymously use an example of a company that I've worked with for a while that sort of evolved from being, they were a big splash in the NFT space. They had some good contracts. They've moved past that now, but everything they do is still tied to digital assets. But it's much more tied toward a story. They're working on videos and movies. They're developing a whole cast of characters that all is going to be existing as digital assets. And that introduces a whole nother layer of risk, because they're dealing with all sorts of IP issues, right? And they have already run into some things where, they're going to have to deal with some other parties who might think that they have an IP. And that's not one of those, IP isn't one of those things that pops up on a list of the typical, digital asset risks, right? When you look up all these articles, they've got 3 or 4 things, but that's a real issue. And if you have a real going forward business, it could be an expensive issue. And so dealing with that, and what if you get sued, and we can come to it later, but will you have insurance coverage? And how will that work, right? Or are you going to be on your own?
Yeah, not good to be set adrift on your own without any tools or mitigation, for sure. But we're going to talk about problems first, and then we'll end up in a high note with some solutions. But Mark, we talked about something very mundane, as in individuals holding crypto, and in some instances receiving crypto and not getting 1099 forms, or not knowing how to, if their mark to market was averaged over the course of a year, was it done daily? Well, talk about some of those kind of problems which affect both institutions and retail.
Absolutely. Well, you mentioned 1099 forms. There's multiple types of 1099 forms. The one that I believe we were talking about was a 1099 you give to a contractor saying, okay, I paid you that $80,000 worth of digital assets, value those assets at the time you paid them, and then that's the number you report on that 1099. But there's also, there's supposed to be a 1099-crypto now. So in 2021, there was the Tax Cuts and Jobs Act that passed. I'm sorry, the Infrastructure Bill, not the Tax Cuts and Jobs Act. The Infrastructure Bill mentioned that going forward, crypto exchanges will need to give 1099 forms out. And you normally get 1099-B forms from your, did my mic cut out?
It's okay.
You normally get a 1099-B form from a brokerage account that you might own. The digital asset companies would have to either file this 1099-B, or the Treasury Department would need to come up with a new form. And it kind of made sense for them to come up with a new form. And the thought was that we'd have a 1099-crypto that we'd be receiving by January, mid-January, and definitely by February of 2024. But none of you got 1099-cryptos in the mail because they don't exist yet. The Treasury Department dropped the ball. So the Treasury Department announced earlier this year, okay, forget it, don't worry about it. We'll issue guidance and possibly a new form at some point in the future. We are still 3 months later in a waiting period, waiting for our 1099-cryptos to one day arrive in the mail. So the way you will generally file taxes on a personal note, if you don't have these 1099 forms, is you'll use some type of crypto accounting solution, cointracker.io, crypto tax calculators, Zen Ledger. There's a couple dozen of these programs out there, and they're not particularly easy to use, but individuals and businesses can use them for accounting solutions to figure out what they owe.
You know, sometimes I just wonder, you want to be compliant, you're trying to be compliant, and yet you can't even get the right form. And I have also heard that you'll be lucky if you're doing all of this to even get a 1099, because sometimes you don't even receive a 1099 form. Yes, there's still a lot of work to be done.
Try dealing with the State of Illinois Secretary of State's office for franchise taxes.
Okay, well, there's a whole set of other tax-related issues. But the point being is, a simple thing as a crypto form that should have been issued has obviously been delayed and causes now more friction in the markets. And so, to me, you know, this is yet another, you would think it's a low-hanging fruit thing to remove, but it's still a friction point.
Yeah, and that law was passed in 2020, it was 2021. It was November of 2021, the Infrastructure and Jobs Act passed.
Yeah.
And we're still waiting for some guidance on that.
And I think that actually raises a good point. A lot of people call for regulation, and also legal clarity. It takes time, even after a bill is passed, for something to then practically get into the system, to then practically be implementable. And I think this is just a small example of something that should have been relatively easy. That's still a friction point. Jared, let's talk a little bit about insurance, because you would think that people who want to get insurance of some kind in the crypto space could now get it easily.
Well, I think the problem is that it's gotten a lot better, but the typical insurance conversation was, so here's the deal. I'm going to have $100 million of assets, and if they go down in value in any way, you're going to give me $100 million. And I'm like, well, that's just like a really crappy option that I don't want to be on the other side of. That's not what insurance is for, right? And also you see these companies that say, we offer insurance, or they imply that they're offering an insurance solution, but they may not be. So I think, you know, first off, I'd say, what is it that like insurance is there for? It's to underwrite a specific risk, transfer that risk through some sort of financial indemnity, right? It doesn't mean it's unlimited, right? Oh, I got sued, my D&O is going to come into place. Maybe. In general, if you're operating a company, you should have D&O insurance. This has nothing to do with crypto. If you have operational risk, or you have this typically larger commercial partners, you'll probably want an errors and omissions policy. Ultimately, I think you need to find a good broker who understands this space, because there are some very crypto-specific risks, and make sure that you're clear as to what the risk is you're trying to transfer, and make sure you're speaking to the actual person that's or entity that's issuing the insurance policy. We oftentimes get into this kind of annoying game of telephone, right, where the broker says, I need a policy for this. And we're like, well, what do you need? Well, I need a crime policy. Well, what's the risk? Well, I just need a crime policy. And then we talk to the client, we find out, well, that's not actually what they need based off of their business. You know, the generic insurance stuff that you want to get, you know, these are very typical general liability stuff. That's not specifically to crypto, it's just that people are very hesitant to underwrite anything in the crypto space because they're all scared that somehow they have some sort of exposure. I would also say that if you have insurance or think about insurance for any sort of crypto-specific risks, I will shamelessly shill, but if you don't have a policy from us, then I would pretty much, I'd scrutinize it very heavily. We try to be very transparent as to what is or is not covered. We have a number of clients that have moved over from other carriers because they looked at their insurance policy and realized they were paying a lot of money for basically no coverage, because what the policy was covering for them was not actually how they operated. And I think this goes back to your point, which is that there are a lot of risks, right? So, you know, when we look at risk, we look at it holistically, and there's the operational risk, right? So a lot of this is not crypto specific. Do you have good accounting controls? Do you have good internal controls? Do you have redundancy in your system? Do you have strong IT protections? We see that a lot of times when there are loss events or other issues, they're conventional, Web 2 cyber issues. They're not crypto specific. So again, are you doing the basics correct? And then you do get to the crypto specific stuff, which is we're using really advanced stuff. I mean, people throw around terms like zero knowledge proofs like it's like just an obvious thing, right? Go to a national cryptography conference, all right? You'll go to a cryptography conference with professional cryptographers, and only a small subset of them would even pretend that they're experts in this space. And we have people who don't even know what what a billion group is, right? Sitting there talking about like, yeah, zero knowledge proof, yeah, it's super easy, right? So there is like legitimate technology risk here, and the number of times when I've had some like crypto bro who thinks like I'm a putz, go and be like, oh, whatever, you're just a dumb insurance person. Then you realize that they have like all their private keys stored on pieces of paper in someone's desk, and they have no controls over that, no logging and no monitoring, and like their CFO is going like this, and their insurance broker is like this. Then you realize that, maybe like the basics matter. And so like with everything, let's start with the fundamentals. Understand what your business is. Understand why you're doing certain things. If you're a long crypto fund, do you really need to have a warm wallet? Or can you just put in really deep cold storage because you're barely touching the stuff? And this is the sort of thinking that we want our clients to have. It's certain things that on the professional service side we help our clients with, and it's the things that we look for from an underwriting perspective. But I would say this, if you are going down the insurance road, understand insurance is to transfer specific types of risk. It's not a get out of jail free card. It's not unlimited, okay? And you should understand what your coverages are. And if you are thinking about getting insurance, I highly recommend that you find a broker very, very much experienced in this space. And most of the ones who sit there and say, oh, we have a digital asset group, we know what we're doing, they're kind of pushing their kind of large insurance brokering kind of brand. You should be making sure that the people on the other side are actually doing
Let me
this.
ask you a very specific Evertas question.
Do not interrupt, sir.
Question. Smart contract risk. Is that something that insurance is equipped to handle? I know you know what a smart contract is. I know what a smart contract is. But maybe you could tease that out as an example. That's a new thing that we wouldn't have talked about 30 years ago. How do you cover it?
Man, I want to make a lawyer joke really badly right now. What's the difference between a smart contract and a dumb contract? Right, dumb contracts are written by lawyers. Wrong crowd. All right.
Know your audience, man.
It's all right. I'll be out there later for the lashings. So, smart contract risk specifically. Thank you for hijacking the panel, Pally. It's definitely, there are smart contracts that I would be interested in insuring. I think that the problem with smart contract, I think the biggest problem with smart contract insurance, and we are, I think, the first company to actually have a smart contract insurance product. We had one in January 22. We have a newer version that's a little bit more scalable and more affordable now, but one of the problems that you have is there's kind of a price mismatch, right? So it's like, yeah, I can get you $5 million of coverage or maybe $10 million of coverage in a smart contract. If you have, $1.5 billion in there, do you really care? And it's not worth the premiums. So yes, there's this intellectual conversation of is smart contract insurance viable through the current insurance markets? And the answer is, no, in that there's a mismatch, and it's yes, in that yes, you can get a piece of paper that says there's insurance on here. And there are things that we could do to potentially scale that. But I do think that, I think there are different ways of approaching risk transference that meet the needs that the insurance market has filled in that are not conventional insurance. And those are things that we think about and we'll hopefully be working on as well. I can answer more specific questions if you want.
There's a question here, which is, as an insurance lawyer, you think about first-party risk, third-party risk, insurance for your own stuff, insurance for lawsuits, getting sued. When you're insuring a smart contract, when you're as an underwriter or someone underwriting that risk, what does it mean? What are you insuring? Are you insuring flaw in the code that causes unintended third-party damage, or are you insuring assets locked in it? Who's the insured? Who's a potential claimant?
So I want everyone to understand that Pally had made the comment that he was looking forward to deposing me one day, and then he took me on as a client and said he couldn't. So I think this is his revenge. You're not getting one. So it's actually a really interesting point, and this actually goes back to my earlier point when I said, like, don't tell me what insurance policies you want, like, explain to me what risks you're trying to transfer, because someone will say to me, well, I need a crime policy. Well, okay, for what? Well, I have a custody solution that I sell. All right, well, is that a crime policy or is that a tech policy? And the answer is, you really don't care. Okay, which is why we hired this amazing insurance lawyer who got very sick, and then we worked with Stephen Pally, who's an even more amazing insurance lawyer, to make our insurance contract, which is, really from the ground up designed from a crypto native standpoint to solve these questions, because you as the end customer don't actually care. So I can write a smart contract insurance. In fact, we would write it as a tech policy, which is there is code in there, it's supposed to do something. We've got comfortable that the code is going to function properly. It has not functioned properly, and there's some harm. All right, and then of course whoever's the holder of the contract, presumably the protocol or foundation that supports it, would get the payout. But calling that a crime policy doesn't necessarily help, because is it a crime policy, or is it that yes, someone stole it, but is it that like the code malfunctioned so someone was able to take it? And like these sorts of existential questions, which is like the crap that insurance companies do to not pay out their claims, is not to your benefit. But like there are really interesting things here, because if you go and you say, well, whatever, I don't want to bore you for the next 15 minutes talking about insurance mumbo jumbo, but like, in the traditional world, like it's like, okay, someone stole something from me, right? Like the thing is gone. But in the digital world, you have this weird situation where you have these digital bearer assets. And so there's a technical component to the risk. There's also the normal, like, malicious components of risk. And then there's, like, kind of like the general force majeure, right? Like, there's a hurricane here, and there's an earthquake there, and a sinkhole opens up there, and a tsunami there, and oh, God, all 4 of my backup sites got destroyed. What do you do then? And so it's very important.
Give notice.
Pardon?
Give notice.
Yeah, right. No, but I mean, it's really important to understand what risks you're trying to transfer. Now, don't get me wrong, there are people that get insurance because they just need a piece of paper that says insurance, right? They're a counterparty, whether it's a commercial counterparty or a regulator, or, for marketing purposes, they want to say, I have insurance, and there's some, oh, I have insurance, sounds great.
I think one thing that's interesting, though, about the smart contract insurance idea that I think Steve's getting at a little bit is, traditionally insurance companies don't insure you for your breach of contract. Even I am not going to sit here and say, oh, don't worry, I'll get you coverage when you decide to breach your contract. And so when you're talking about...
broker, that's why.
Right, that's right. I'm a lawyer, I don't lie, I just only tell you what you need to know. And so the idea, though, is you can get coverage, and there's been coverage for, centuries, that will pay for performance of your contract, such as an indemnity obligation, right? And that's been around a long time. And so when you're talking about insuring a smart contract that's automated, you'd like to think that insurance companies would be able to embrace it. So far, we have Jay, who's able to embrace it in terms of a concept that you can insure because it's supposed to function. Now, if the software fails, that maybe is a different type of risk, right? Then we're talking about, well, okay, we all intended to do something. No one intended this not to happen. We had a technical failure, right? And is that going to fall under that same type of insurance? And that is a little bit different from your typical contract situation where technology isn't the sole or at least primary driver of whether or not you can perform under the contract. Normally, it's much more about the party's intent, or you've built in some kind of clause that there was force majeure, right? And so then the insurance has historically been able to deal with it through those means. And you go back to the terms of the contract. But then that raises another issue, which is going back to the terms of the contract and having an insurance company that can understand the smart contract, the code that drives it, and understood what risk they were underwriting in the first place.
Well, this also kind of circles back to kind of best practices and a lot of the things that Mark brought up when we were prepping about kind of normal accounting best practices also apply, right? Which is, when we look at a smart contract, we're going to say, okay, great, you got an audit. I mean, the audit is a good tool to kind of define coverage, right? It's very easy to say, okay, this has been audited, someone competent says that this works, right? And, as long as it stays the same, we believe
code audit, yeah.
But one of the problems that you also have and the things that we underwrite towards are kind of just your controls around it. And it doesn't matter whether it's a DAO or a centralized entity, right, or a corporation, right? We want to make sure that there are controls that you're logging, who's changing things, who's editing the code, who's updating it, what your progress is. Do you have a bug bounty program? Do you have a way to report bugs? does it actually work? Like you're going to pay it out, and so, I mean, I don't know what you've seen in terms of like general best practice controls, whether it's from a smart contract perspective or just in general, operationally.
Well, those controls expand to every area of your organization. It's how you hire employees, what responsibilities you trust them with, how you split up different roles at the company. So one person doesn't have the potential to steal all your cryptocurrency. Maybe they can only just steal a portion, or maybe they need to collude with other individuals. You need to build checks and policies in place to prevent that. You also need good general cybersecurity overall for your company. If your overall IT department is not in good shape and doesn't have good policies in place, that can filter through and cause you to potentially lose these assets. Even if you don't touch a smart contract, you could just have the bookkeeper could run off with the crypto. You don't want that. Your chances of recovery, and you, as a fraud expert in this area, I can tell you, are very low. Even if you know who took your crypto, let's say it was the CFO or the bookkeeper or one of your former employees, and even if you know who they are and where they are and you can get them arrested, your chances of recovery are pretty low because they probably spent it already. That's just the way it is with any and all frauds, even with dollars. It's just a major problem. Now, if you were hacked, on the other hand, your odds of recovery are even lower because the hacking probably happened. The crypto, I could trace it. It's probably going to go to some Bitcoin address, then to maybe a mixer, or it's going to go to some exchange located in Estonia or Vietnam. You're not going to be able to send a subpoena. You're not going to be able to get that back. The only solution is you want to avoid the risk before it happens. You want to have good controls in place, and also diversification. If you diversify not just your investments, where you're in different cryptocurrencies, but you spread the risk out among multiple employees. Maybe you have a large number of exchanges you use. That can reduce your risk and diversify it out. It's kind of a free insurance policy in a way. If I put all my money in Coinbase, let's say, and Dan put all his money in FTX, well, you could say that was smart of me, but that's not really the right way to look at it. We both concentrated our assets in one location. That was a bad move on both of our parts. On the other hand, if Jay here kept his money spread across 4 different exchanges, even if one of those exchanges was FTX, you still have 3/4 of your money.
Having been and still currently a Silicon Valley Bank customer, I got a very real-world lesson in this.
Yeah.
And one thing to think about too is, and Mark is exactly right. And so if you're hacked and you lose digital assets, and you go to look at your cyber policy, for example, which you have in place because you might get hacked, is it going to provide coverage for those digital assets, right? It might provide coverage for a lot of other loss coming out of that hack or that incident, cyber incident, however it's defined in the policy. But the digital assets themselves, in most cyber policies, you're going to have a difficult time getting
Pretty
that
much
covered.
all. I think they actually changed like the ISO form to explicitly exclude them.
So if you talk, I am not going to say that out loud, but yes, there are insurance companies that will take the position that they are affirmatively excluded. Yes. And so, there are still arguments depending on exactly what those digital assets are that perhaps you could get coverage, but it's very difficult. We've had some bad rulings, even under property policies where they have an extension for digital media, where courts have said, yeah, but that doesn't include software, because software, I guess it just doesn't even exist. It's just the data.
That's, by the way, that's kind of bogus if you look at how, like, the history of the insurance markets for crypto, right? They came to the special market. So they were entirely insuring property that was storing things. They're like, we're not storing the digital asset, we're storing the media that's holding the private keys. But sorry to all of you who don't know insurances, and God bless you, you're better off for it.
You've got to love the passion that's in this room, or at least on the stage. We've got a number of minutes left, and I want to make sure, in case anyone else has a question they'd like to ask the panelists, that they get that chance. But before we do that, I want to actually provide the audience here. You've mentioned a number of solutions and tools. I think we need to just kind of make sure we round this up. So standards, best practices. Mark, you were excellent at delineating a number of things that corporations can do. But what else needs to happen in order for the industry in some ways to catch up with the way, let's say, traditional financial services and or other businesses operate and mitigate their risks? Or is that not applicable?
Yeah, no, I mean, in a lot of other, what people might call more mature industries, you have risk managers, and literally they can go from one company to another, and they have their checklist, right? They can sit down and say, okay, here's what we need to look at as the big risks. Here's the ones we can probably, address with insurance coverage. Here are other ones we need to have, internal controls built around. We don't really have that in this industry. We're getting there. Huge strides have been made. Some of these bankruptcies have exposed some of the weak spots. Some of what was involved in these bankruptcies was just good old-fashioned fraud, which is a different issue. But they have led to exposures of different types of risks, some of which is going to be litigated even after these bankruptcies and sort of the fallout of these bankruptcies. And we'll see who ends up being liable. And that will drive some of what can be addressed with liability coverage. And so in terms of thinking about it, a lot of these businesses we deal with, they have a lot of compliance going on, but they don't have the risk manager function. And so there's no one performing that. And that is something that I think will have to evolve in order for a lot of companies to survive.
That is an excellent point. How many crypto and or blockchain organizations do you know that has like a chief risk officer or even a risk manager? Right? There you go. That's an easy one to actually plug that whole gap.
Yeah.
Mark?
Yeah, I'd say in this industry, the resources we have to manage risk are much less than in the traditional world. Normal companies, they hire lawyers and accountants to address these regulatory issues that, like I said before, there's a lot of uncertainty in those areas. You need a clear law, and you need case law from the courts, and you need clear forms that you can file for your taxes. You need these things to mitigate your risk, and for people like accountants, your lawyers, and your insurance professionals to make decisions, they need this clarity, and we're very often lacking in that clarity. Luckily we do have some companies that are coming up with like technological solutions, payment processors, and companies that offer like wallet custody services. And we can do that from a tech standpoint, but we don't have the ability to push these court cases forward any more quickly than they are. But I look forward to the days when those risks are more easily mitigatable with knowledgeable professionals, because there's actual case law and laws that we can point to, and or tax forms.
I just want to highlight a question that I always ask when I'm looking to invest in a company as an angel investor. Okay, you've solved this set of problems, and you've articulated, you say you're solving this set of problems. What new problems have you created, and what are the risks of that, and how are you managing that? Entrepreneurs generally don't like that question, but it's important because for every solution you've solved for, you're probably creating another set of risks and potential problems, and you need to be aware of that. So again, it's not about, Jared, I'll let you have the last word, but it's not about solving for a blanket insurance that covers all risks. It's very specific risk transfer, and you need to know what risks you're dealing with.
So obviously, you all need to buy as much insurance as you can exclusively from Evertas.
I agree. Otherwise, I can't help you.
Yeah, we're going to have a booth outside. We take checks, crypto, whatever. Actually, we could take crypto, but all kidding aside, I mean, look, insurance is part of a risk management kind of program. I think, compared to, in some ways, we have a lot more advantages compared to, I'd say, the legacy financial institutions in that we don't have all the technical debt, right? We can iterate more quickly through technology, right? So we can actually start, and we start off in a better place from a security and technology standpoint, generally speaking. It's a very broad industry, right? From, shitcoins and scams on one end to basically, banks, very traditional publicly listed companies and financial institutions on the other. And you have smart contracts and DAOs and a bunch of other stuff in between. And even within there, you have, really high quality, well-run projects. You have your Gnosis contracts, and you have, the whatever, just put here, I don't care, I'm going to rug them anyway kind of contracts. And so I think that there are some inherent advantages to this industry, and we shouldn't poo-poo them. I also think that, putting aside the regulatory and legal risk, which again, clarity and, hiring competent counsel and advice, either accounting or legal, is always important. There is this kind of financial risk piece, which, again, it depends on the type of business you're doing and how interconnected these things are. And I don't think you necessarily need to wait for regulations to go sit down and say, hey, if you have a financial exposure, what is it? And again, not a lawyer, but if you're going to if you think that you might have an issue, call a lawyer, and generally be, I think, transparent and kind of disclose what the potential risks are. So if things do go south, at least you can say, hey, we told you. Don't try to kind of hide it under the rug. But there is, risk is a holistic thing, and every single thing that Mark's an accountant. I'm guessing you're traditionally trained accountant, you kind of ended up in crypto, right? You probably,
right.
Yeah. Everything he listed, all these best practices, they still apply, right? Just because the Borgias created double accounting, 500 years ago, doesn't mean that it doesn't apply. And I think there's this arrogance with youth and new technology, where you think that everything is new and you're smarter and the old fogies don't know what the hell they're talking about. But some of this stuff actually stands the test of time for a reason. And I'm sure I'm preaching to the choir with this audience, but there is a lot of good knowledge and good best practices that can be applied from other industries. We don't have to relearn every lesson by putting our hand on the hot stove.
Yes, but that convergence, melding the two worlds together, are often where the challenges lie. Does anyone have a question that they'd like to ask? Otherwise, we will wrap up here. All right.
I don't think that crypto natives, and by the way, I started Plum Labs after, working at Ripple. So, now I do consider myself crypto native. I think crypto natives, it's not that they don't understand risk management. It's not that they don't have a chief risk officer, right? When I was at Goldman, chief risk officer was a C-suite person, right? They have a chief risk officer, but they just sit under treasury or the CFO, and it's not really a C-suite function. And the reason is because in the markets, up until last week, the gains were 60+% if you were degen, right? It was bananas. And the downside risk was calculated at 20%. So there is no way that I'm going to allocate working capital where I have 60% gains to cover risks, and when my risk is 20% downside, right? And so it was just a pure economic reason why these companies were not prioritizing risk. We do see a shift in that now, today.
Right.
All of a sudden, I went from founding a company, people just kind of ignoring me and say, I don't want to talk to you about risk. That's super boring. Let's go grab mimosas, right? To suddenly I'm getting inbound calls saying, oh shit, we need to figure this out because if we get audited, we don't have an answer, right?
Right.
So my question is do you really think that the answer should come from a governmental purpose, or should it come from this ethos of actually promoting institutional grade infrastructure into crypto assets, right? Because those are two different things. One is mandated and one is creating a blueprint saying this is how the institutions do it and this is how Web3 needs to do it moving forward.
So I'm sure all of us have comments on this. My answer is two-pronged. The first one is, yeah, I think that we should be doing this endogenously within the industry. Historically, we've been piss poor at it. And, one of the things that kind of drives me crazy, and, you talked about starting a risk company, try starting an insurance company 7 years ago in crypto. No one even invited me for mimosas.
Well, now you're like Marsh, right? Marsh just made that announcement. Now everyone's trying to get into the space.
I won't comment about them recycling old news.
We're at our time, so.
Yeah, but we should be doing this, and I think that as an industry, we should care more about it. When unfortunately has been, hey, we're going to degen, make some money, and whoever gets burned, and YOLO. That's not the mark of a ubiquitous, highly used professional industry. The second prong is whether we like it or not, the regulations are coming. I have my own views on this. I think they can be helpful. I think there have been some downfalls, but
as are
I think
third-party
both
claims. And that is also going to be a driver that isn't necessarily the government, but will drive the risk issue. And as gains don't maintain that super high level, third-party lawsuits become riskier looking.
Thank you, guys. Unfortunately, we're going to have to wrap up because I'm getting the
cane.
virtual cane. Okay. Thank you.